Welcome to the Power Up and Market Update. It is 10:05. We're doing the 2025 market update with Mr. Barry Habib. I'm so excited to be here with all of you. As promised, we are going to get started up here. I am going to go through about 5 or 6 different updates, and then we're going to get straight through to it because I definitely want Barry to cover as much as possible in today's Zoom. So I just want to take a quick moment and just tune into gratitude, because as you guys already know, gratitude is an abundance multiplier. So let's go ahead and flood the chat, put in something, at least one thing that you could be grateful for today. It could be anything. It could be just, hey, I woke up today. I have the ability to see. I have the ability to hear. I'm going to listen to Barry Habib today. Anything that you're grateful for, put it in the chat. I want to start off this Zoom with a lot of gratitude. Miss Terry, yes, for today, to be alive. Yes, life. Yes, this beautiful life. Absolutely. This new journey with EXP. Yes, absolutely. Yes, grateful for Mr. Barry Habib. Absolutely. Absolutely. Keep flooding the chat with gratitude, guys. Keep flooding the chat with gratitude. Let's go. Let's go. Grateful for family. Yes. Health and prosperity. I love it. I love it. Thankful for life by 4 miles. Let's go, Nelson. Life. Yes, absolutely. Absolutely. Grateful for life and family. Love it. Thank you guys so much for sharing some gratitude and some very, 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 very deep gratitude to all of the veterans that have served our country. Thank you so much to each and every single one of the individuals that have served our country. I'm sure you guys have family, friends, colleagues, right, that have served our country. So thank you for all the men and women that have made a difference for all of us in our amazing nation. So just wanted to take a little moment to acknowledge that. And I just wanted to share our goal, right? Our goal is to serve 21,000 families, $10 billion in production, and to attract 10,000 agents to our community. I'm not going to go into a local market update because we're going to talk about exactly that with Mr. Barry Habib. So I'm not going to cover that. I just wanted to give you guys a quick reminder. Here's our training for the week. We have about 18 hours outlined for all of you. And if you guys are on our email list, you guys receive the newsletter on Saturday where it shows you everything. We cover everything: luxury, international, commercial, role playing, skill building. We also have some really cool events that are coming up that I do want to cover. We have the Monday Mastermind, we have a Skills Mastery, and we also have a Realtor Mastermind this week with an amazing gentleman that's out of Texas that has built a personal brand to build a ultra successful team. This can happen this Wednesday. We're also doing a live event in the city of Chino Hills called Breakthrough. Mr. Will Higgins will drop it into the chat, but make sure you guys register, invite people to this event. We are making it free. And it's happening right around the corner on the 21st. And also, Mr. Joseph Trujillo is hosting an Iconic Success Academy that's starting very, very soon. And I'm sure he's going to be dropping the link here for you guys to be able to register. So another thing, well, let me get to Mr. Barry Habib because I want to make sure that he shares. I'm going to just cover a little bit of his bio. Again, I had the opportunity to share the stage with this man out in Sacramento, California, and I was over the top impressed by the information, the value he provided, and his generosity and his commitment to excellence. So Barry Habib is the CEO of MBS Highway and is an American entrepreneur and frequent media resource for his mortgage and housing expertise. Amazon's #1 best-selling author for his book, Money in the Streets, widely credited with saving the mortgage industry in 2020 from margin calls to Fed action. His presentation to the Fed created stability at a crucial time. Notable awards: 3-time Crystal Ball Award winner by Fannie Mae, Pulsonomics, and Zillow for most accurate real estate forecast out of 150 of the top economists in the U.S. 2019 Mortgage Professional of the Year, finalist of Ernst & Young Entrepreneur of the Year, named Mortgage Global 100 list, the St. Armand Ventures Businessman of the Year 2021, named to the list of the top 100 people to watch in 2023. And during his mortgage sales career, Barry personally originated over $2 billion in production. He leads producers and managing partners for Rock of Ages, the 27th longest running show in Broadway history, which he also took around the world and turned into a major movie starring Tom Cruise. He produced Chris's Angels, Mind Freak at Planet Hollywood in Vegas. He is the highest rated speaker and trainer for over 25 years in the mortgage and real estate space. Mr. Barry Habib, without further ado, welcome to the Zoom. Thank you so much for being here. Appreciate you, bro. Let's go. And I think you have the ability to unmute yourself. Let me see. We have go ahead. Oh, there you go. I think you
Okay,
should
there
be
we
good to
go.
go. There
Awesome.
you go.
Awesome. We're on. Thank you so much, Leo. Thank you for the kind words. Hi, everybody. Hope you guys are doing great. It's wonderful to have a chance to be with you. I want to talk a little bit today about what to expect in the interest rate environment and the real estate environment and how important it is as realtors to really up your game. Because listen, there's a lot going on. That have you followed what's been going on with Landian? And you had the whole mess that we had gotten into with the National Association of Realtors, where you don't have the cooperative compensation agreement allowed anymore. Well, that same guy, Josh Sitzer, who began that lawsuit, now has started a company, Landian, to compete with you guys. But if you look at their website, Landian, look at the ads that they have on there, essentially what they're telling people to do is to not use a realtor. They say it's in their not in their best interest to use a realtor and to use Landian because they're going to show homes for $50 a home or a total fee of $1,500. So I mean, just think about that on a 6 or 7, and they promote this heavily. So how do we distinguish ourselves? How do we make ourselves valuable and even more valuable in a competitive environment? So that's what we're going to do today. We're going to go through a lot of things. So please, I want you to stay focused. I want you to take good notes because I'm going to take you places, as Leo knows, that other people will not share with you, will not give you the type of insights because we have a deep understanding of it. So listen, I'm just going to get started to be respectful of your time. We're going to share some slides with you. So let's do that right now. So yes, today we're going to look at overcoming adversities that are out there, finding opportunities. We're going to look at the Fed. The Fed has been very much in focus. It's important to us, interest rates, and we're going to look at the housing market. So let's get started. Now, Leo didn't mention it, but I'm one of Tony Robbins' Wealth Master teachers. And Tony and I are dear friends. I do his Lions group, his top 50 clients. I do his Wealth Mastery, and I do his Platinum group. So in those groups, what we really focus on is, since most of the people are salespeople that are trying to improve themselves, just like you and I, the best way to increase your income, best way, fastest way to increase your income, what Tony and I are locked arm in arm on, and we believe this is simply it. Here's the secret. There's one thing to do, and that is just close more of the opportunities you already have. Don't want you to spend a whole bunch of money. Don't want you to waste a whole bunch of time. Don't want you to go and increase your funnel. Now, you can do all those things, and certainly I'm not saying that would be detrimental, but what's the single most effective, fastest way to increase your income is just take all the chances you have and convert more of them. Wouldn't you agree? That's simple. You already have the people in your hand. You're already talking to them. You're already meeting with them, but turn more of them into transactions, lose less to your competition. So how do we do that? Well, I believe that the important ways to do that, number one, is to gain trust. And I think we'd all agree that trust is magic. I mean, you think about all the things you've got to go through today that are inconvenient, remembering all your darn passwords, going through an airport, going through compliance. All those things are because there's a lack of trust, and it's inefficient. It wastes time. It's expensive. But even on a personal level, I mean, you think about if you don't have trust within your family, or how about your love relationship? I mean, when there's a love relationship that they don't trust each other, maybe you've been there. It's toxic. So think about how important trust really is. What about if you're in a relationship where you do trust each other? How magical is that? How seamless is that? And with our clients, or when you're the customer, I think that you have experienced times where you don't get a good feeling about the salesperson and you just don't trust them fully. And you'll wind up paying more to go to somebody else because you trust them. So how do we make that magic happen? What is the magical way for us to gain trust? Well, I think we do it really two ways. Okay, so the first is by being vulnerable. Now, vulnerability is hard because our ego gets in the way and fear gets in the way. So those two things have to be overcome. So being vulnerable, being honest, this is the key. So let me give you an example of this. I'm sure you've gone to a clothing store, and everything you try on, there's a salesperson that says, "Oh, that's beautiful. Oh, that's fantastic. Oh, that's one." I've been there. Now, look, I don't care how freaking good looking you are. Not everything is going to be perfect on you, right? But what if the salesperson would say, "I wouldn't get that," or "No, I don't think that looks great on you." You would trust them more. Let me give you another example. Car salespersons. Sometimes car salespeople don't have the greatest reputation. Why? Because they just try and push everything on you. So let me give you an example. Let's just say you or I are really, really desiring, we're kind of hot for this new car. Maybe it's a sports car, and we really love it. We've seen the commercials, we've seen it on the road, and we're like, man, I really wish I could have one of those. And you go to the dealership because you're in the market for a car, and then you see it there. It's beautiful. You take it for a test drive. And man, it's all we could do to not be drooling in front of the salesperson because that's how excited we are. So now think of the approach from the salesperson. The salesperson knows we're all over it. An inexperienced salesperson would just go for the kill and try and make the sale, but that's being transactional. That's not going to gain any trust. That's not going to build a relationship. What about a salesperson who did this? And this is the way we need to approach everything. First thing you need to ask, what are your thoughts? And then please don't say anything. Okay. I know we're saying, what are your thoughts? And then what about this? No, just what are your thoughts? Because what will happen is that if there's things that they like, they'll explain them to you. Oh my gosh, well, it's beautiful. Man, I love the way the car feels. It's comfortable. And oh my gosh, the way it handles, it's great. Now, who's going to do a better job of selling them? Me or themselves? Obviously, the answer is themselves. So that's a really important question to remember in all sales. What are your thoughts? And then let them tell you their thoughts and then work off of that. And then the second question you should always ask, and most salespeople don't go there because they're afraid of negativity. What are your concerns? Think about that. Because so many times they have concerns, but they don't bring them to you. They'll discuss it with somebody else who's inexperienced, a family member, a competitor. What are your concerns? And then if they don't even have any concerns, well, I don't really have any concerns. No, this is great. Give them concerns. You might think that's crazy, but let me explain to you how effective this can be. So when you say to them, well, I'm glad you don't have any concerns, but I do want to explain one thing to you. You mentioned you really love the way the car handles. Oh, yes, the car handles great. Well, part of the reason why the car handles that way, of course, it's got great suspension and the steering is amazing. But this sports car, it's got tires that grip the road exceptionally well, which means they're made of a little bit softer compound than the car I see you have outside. What I want to tell you is that that means they may need to be replaced a little bit sooner than you're accustomed to. And I also want to tell you they're not inexpensive. So before you buy the car, I don't want you to have any surprises. I just want you to know that before you decide to buy the car. Now, think about that. Let me ask you, and if you want to put it in the chat, that'll be awfully nice. What words come to mind when you are, I'm looking at the chat window, that's why. I can trust you, Hilda says. What words come to your mind about the salesperson? What come? Honest, right? Honest, trustworthy, transparency. What else comes to mind? Looking out for me, considerate, sincere. Okay, now that's great. Thank you, guys. That's good enough. Thank you. Keeping it real. No BS. Okay, knowledgeable. But do you see the magic here? What's the most important thing? Trust, right? Now, did I gain your trust by telling you how great this car was? Did I gain your trust by telling you how fast it was, how the great price is, how I'm better than my competition? Or did I gain your trust by telling you, here's something to be careful of. Here's something to warn you about. He's actually helping somebody, says, not hungry for the sale. You guys are getting it. This is a very smart group. God bless you guys. You guys are really, really good. But that's the point. But it takes courage to say, let me give you some concerns, basically, to say, here's something to watch out for. Now, how about when you show a home? I'll tell you what most of your competition does. They sell the features. Oh, look at this is great. This is great. This you get great. This you get blah, blah, blah. Their guard is up. How do you get their guard to come down? Well, you're probably going to need to replace this. So I want you to think about that. Or here's something that you should watch out for. Or did you know that it has a nice view, but there may be building a building here. So I want you to think about that first. Look, they're in the market to buy a home. They're going to buy a home. If you gain their trust, they're going to buy the home from you, and they're going to buy the next one from you, and they're going to tell everybody else about you. And this is why it is absolutely critical for you to be able to do this. It's absolutely critical for you to be able to explain to them the benefits and what they should be cautious about. So that's vulnerability. The second is knowledge. You see, information is what most people have. but information is free. If I want to find out something, I'll Google it, chat GPT it. I don't expect to pay for it, right? So if you only have information, you're not providing something that people are willing to pay for. But wisdom, we pay for. When you go to a very good doctor to get their advice, an attorney to get their advice, a coach to get their advice, you pay for that because you're paying for wisdom. That's the position we need to be in. So, what business are we really in? Yes, we're in the real estate business, but wouldn't you agree it has to do with the financial markets? Let me give you an example. Look, I've been doing this for a very long time, since 1986, between real estate and mortgage and teaching. So, been around the block a little bit. And in my career, I can tell you that every transaction that I had, every single customer, and maybe it's the same for you, I'm pretty sure it is, would ask you, is this a good time to buy? Is the price going to be vulnerable for a drop? Is there a bubble? Is my investment safe? Is what they really want to know, right? Is this a good deal I'm getting? And they turn to you for that. And then they might say, well, which way do you think interest rates are headed? Now, let me just explain to you how 99% or more of your competition answers the question. Well, market's pretty good right now. Yeah, it's pretty strong. And interest rates, well, boy, if I knew which way interest rates are headed, I'd be having a pina colada on the beach someplace. Now, that might be something that is okay, but you didn't really show yourself as either vulnerable or that you have wisdom. The two magical things you need to gain trust. So let's talk about that for a little bit. Okay, let's go through a couple of things and let's take it step by step, team. So I think we'd all agree that finances have a lot to do with this, right? So if I were to ask you, what is the most important financial price in the world? Do you know the answer to that? I mean, we all know that financial stuff has to do with what we do every single day. So let's talk about it. So if we're talking price, it's going to be priced in what currency in the world? Well, the United States is the world's reserve currency, so it's dollars. So what's the cost of dollars? When dollars get circulated, banks charge each other money to circulate the currency. So what is the price that banks charge each other? What is the interest rate they charge each other? That's called the Fed funds rate. So the Fed funds rate, what is the Fed funds rate today? Does anybody know what it is? I'll tell you what, I'd be very impressed if you put it in the chat window. If you know what the Fed funds rate is, anybody want to put that in the chat window? Let's see who's going to, and by the way, it's okay if you get it wrong. So please don't be, we're family here today. Okay. Leo's created this great environment. This is family. So there's no worries about a wrong answer. So boy, Jerry, you nailed it. Perfect. Jerry hit it at 4.625. But I want you to think about this and think about it honestly. Now, Jerry, you nailed it, but very few people can answer that. And that's the most important price in the world. So it all starts with that. And I'll show you why in just a minute. So who sets that Fed funds rate? The Fed. The Federal Reserve sets the Fed funds rate. So what are they going to look at in order to set the Fed funds rate? Two things. The first thing that they're going to look at is inflation. So that's going to be one of the governors of this, is what is the inflation rate? Now, the Fed wants inflation to be at 2%, but by what measuring stick? Okay. So the Fed is going to look at something called core PCE, core personal consumption expenditures. That's what it stands for, core PCE. Why core? Core takes away food prices and energy prices because the Fed says, hey, look, we can cut rates, we can raise rates. But if there's action going on in the Middle East that drives all prices up or down, or if there's weather that causes food prices to go up and down, it doesn't matter what we do with rates. We can't influence that. So they take those two out and they look at the core rate of inflation. They want that to be 2%. So today it's 2.65%. Okay. But if we look at some of the lagging impacts of it, like one of the factors is shelter, but that kind of takes time. It lags, as well as what we've been seeing in the last 6 months and 3 months. We're close to it. So it's a 2.625 now, but we're kind of getting close. We're 2.2, 2.3%. So we're getting to an rate of inflation that the Fed is liking, which is why they've been cutting interest rates, because they see that coming down. Now, what's the second thing that the Fed looks at? That's the unemployment rate. So do you guys know what the unemployment rate is today? Anybody? By the way, Madeline, I don't agree with that. You don't want to say, I will get back to you quickly. These are things you need to know. This is what you need to know this stuff. There's no excuses for this. There's no getting back to you because they're not going to ask you. It's going to be in your script and I'll explain why. So what is the unemployment rate today? Matt's got it. 4.1%. Excellent. 4.1. This is what we need to have. We need to have the 4.1% in our minds because this is only two things we need to know. What's the rate of inflation? Well, rounded, it's 2.7%. Unemployment rate, 4.1%. The Fed wants inflation to be at 2, and they want something called maximum employment. Why is this so important? Well, let's take a look at it. Okay, so now we know that the unemployment rate's 4.1% because we want to understand where mortgage rates could go. So let's talk about this for a minute. Again, remember that person who got called and the realtor answered the question and says, well, I think the market's pretty good. And boy, if I knew where interest rates are headed, I'd be on a beach having a pina colada. Ha ha. Now they call you. And how do you answer the question? So here's the script. So please pay attention carefully. Okay. This is how I would do it. Yes, Mr. Miss Client, that is a very good question. It's a very important question. So first, as far as real estate values go, just like any other commodity, it's going to be based on supply and demand. And me, I have a bird's eye view on the supply side. I can tell you right now, in the zip code that you're looking for, inventory is tight. In fact, it's much tighter than it was pre-COVID. Now it's gone up a little bit over the past year, but it's still about half of what we were experiencing pre-COVID. So supply is tight, but it also depends on demand, right? Demand is going to be heavily influenced by where mortgage rates are. Lower the mortgage rate, the more the demand. Higher the mortgage rate, softer the demand. Now, the National Association of Realtors has told us that for every 1% decline in mortgage rates, 5 million people across America are eligible to purchase a home. Of course, not all of them are going to buy, but think about that in a tight inventory environment, that would spur prices higher. So where do we see mortgage rates? Well, mortgage rates are going to be following the direction of the 10-year Treasury. And the 10-year Treasury is going to be following the direction of the Fed. And right now, the Fed has told us, based upon their summary of economic projections, that they were going to cut this year. They said that they were going to cut 50 basis points. They did. They said they were going to cut 25 basis points last week, and they did. And they're telling us in December, we're going to get another cut. And they're telling us in 2025, they're going to cut maybe 1.25% on top of that. So all those cuts on the Fed funds rate will eventually, there's a lag, but will cause the 10-year Treasury to decline. And that means that mortgage rates will decline. So we see interest rates being pretty favorable. And that means there's more demand in a tight inventory environment where the supply is pretty tight. I think that home prices are well supported. Now, that might have taken 90 seconds, but would you agree that if you had those 90 seconds, that you're a lot better off in getting that deal than the pina colada boy, right? So what's the number one fastest way to increase your income? Simply close more of the opportunities you have. So if you're vulnerable, if you're pointing out things that gains trust, if you're knowledgeable and you gain their trust, your income's going to go up because you're going to close more of the opportunities you have. And you deserve to. You deserve to because you're putting in the work, because you're doing what you should do. All right, let's continue. So where could mortgage rates go? As I mentioned, the Fed said that they definitely intend to reduce interest rates. And here is that summary of economic projections. This is exactly what I was talking about. Here in 2024, the Fed, each dot represents one Fed member. They're looking at another 0.5%, which they did. And next year, they're looking at 1 to 1.25%. That's where most of the Fed members are. So we see interest rates coming down. The 10-year Treasury, it was at 3.6% in September. It's bumped up, but now that the Fed is in a cutting mode, we should see interest rates get back down towards 3.6%. So if the 10-year Treasury is at 3.6%, now we look at how much are mortgage rates typically above the 10-year Treasury? Well, for the last 40 years or so, they've been in a range most of the time where it's between 1.6 and 2% above the 10-year Treasury. But COVID caused this little gyration here, and it kind of got a little crazy on us. But you'll see that last year, we were 3% above the 10-year Treasury, but it's kind of coming back down to a more normal range. Right now, we're about 2.5% above, but I believe we'll get closer to this level. Let's say it drops a little bit more. So where would mortgage rates be? Well, help me with this. So if we think the 10-year Treasury has a good chance to get back to where it was in September, that's 3.6%. And that usually happens. And then the spread above that, we said it's 2.5 right now. But if we think it comes down a little bit more towards normal levels, should we put a placeholder of about 2.25? Yeah. So that means mortgage rates should be at around 5.85, or call it 5 7/8, 5 3/4, right in that range. And if you're in this range, what happens? That's about 1% lower than where they are now, which means you're going to get a lot more buying activity and you're going to see prices go up. So this is the key for us. So should your customer wait for rates to come down? That's going to be a good question, right? Well, maybe I'll wait for rates to come down, right? That's smart. Well, I'll wait till it hits 5 7/8 or 5 3/4, and that's when I'll buy. This is a big mistake because we have to explain to them the benefit of marry the home and date the rate. What does that mean? That means you buy the home now, and the rate that you have is a higher rate for a period of time, and then you refinance to a lower rate. So we can't just say it. We have to explain it. So look, the higher rate may be your best friend. As I explained, for every 1% drop, according to the National Association of Realtors, 5 million more people become eligible, and tight inventory is going to be tighter with those people coming in, less choices for you, and upside pricing pressure. So let's put this in action. So let's take today's value, a $700,000 home. And let's say the loan amount is 20% down. So that means it's a 560 loan amount, and the rate 6.875 today. Here's your payment, $5,075 a month. But if they waited a year, that same 20% down on the value of the home, given that the appreciation on the home over the next year is anticipated to be 4.1%, if the rate's lower at 5.875, their monthly payment would be lower a year from now. So if they buy now, they're paying an extra $182 a month. That's the difference between these two. You wait a year for that lower rate, and that's 12 times this. That's $2,184 more to do the loan today at the higher rate and then refinance. But wait a minute, what about the cost to refinance? Let's throw another $3,500 in there. So to date the rate, meaning you buy the home today and then later on you exchange it for the low rate, it's going to cost you $5,600, $5,700. That's an expensive date. But what's the benefit of marrying the home? Just 4.1, and nobody does this, team. Just the anticipated forecasted appreciation in your zip code of 4.1% on a $700,000 home is $28,700. That's the benefit of marrying the home. So marrying the home minus the cost of dating the rate gives you the reason to do this today, which is a benefit of $23,000. Boom, you could drop the mic right then and there. But this is what you have to do as a real estate agent who is at the top of the food chain. The best of the best do this. Everybody else is selling features of the home. Okay, think about that. You want to distinguish yourself and you want to close more of the opportunities you have. See, this is an opportunity that you have. But somebody's saying, well, maybe I'll wait. They're interested. They want to buy, but now they're hesitant to buy because they're thinking about maybe I should wait for rates to come down. You close them instead of lose them. And this is what you can also do. You could put this into a co-branded thing with your mortgage professional or just you and send it to them and show them this. Now, here's another objection that I'm sure you hear lots. And that is, well, I want to buy the home. I need to buy the home. I've got a baby. I need an extra room. The baby's sleeping in our bedroom. It's kind of ruining our intimacy time. Or I've got a job that allows me to work from home, but there's a lot of activity in the home. It's a little bit loud. I mind up working from home, but it's really working from Starbucks or something like that. And a lot of people are having this. So they want to buy a home that gives them the things they want. Maybe it's a garage, maybe it's a backyard. You know all the reasons. But the problem is when they start shopping for that home, they see 6.875 and they're paying 3.25. So to move up costs them a lot more. And they're in a position where they say, you know what? I just have to wait. I can't afford it. Even if they can afford it, the payment shock gets to them. So here's where you come in and you show them what to do. Look, Mr. and Mrs. Customer, it's true that you got a 3.25% rate, but that's only on your mortgage. Do you have any other debts? Well, this is America. Of course we have debts. We are the most indebted we have ever been in our history right now. So, for example, do you have a car loan? Yes. Let me put that in a blended rate calculator, which weights it by the amount of debt you owe times the interest rate. And you could see here that's closer to 4%. Now, do you have credit cards? Oh, yeah. Major credit cards, store credit cards. Uh, your blended interest rate is pretty close to where rates are today at 6.5. So you're not that far off, 6.5 compared to 6 7/8. So here's the thing most people do. They sell their home and they take all the proceeds from that home and they put it as a down payment on the new home. That's what most of them do. We know that. But the advice is don't do that. There's no tax consequence whatsoever. You don't have to roll all your down payment. What you do is you take your proceeds from the home and first eradicate all your debts. Then what's left, you put as a down payment. You take out a higher mortgage. I bet you in most of the time, your payment on the new home is cheaper, even at the higher rate than you're paying today. And now you give them what they want. You give them the extra room for their baby. You give them the extra room for their work from home. You give them the garage. You give them the backyard. You give them the neighborhood, whatever it is that they want. They want to do this. Just let them do it by making it okay for them. It's a very important technique to understand. Now, sometimes there's a home that's put on the market that's pretty hot and there's multiple bids. I'm sure you've been in this position. Home for six. I mean, all of these are actual case studies I'm giving you. Okay. $630,000 home. Customer, God bless you guys. You take them out. You look at a lot of homes. For a customer to find a home that checks off all the boxes, check, 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 check. It's not easy for you. It's not easy for them. So finally, they find one that they want to move forward. And you say, hey, look, this is a good deal. You should put in a full price offer. So what do? They listen to you. They put in a full price offer, 630. But what happens? You've possibly been in this situation, right? We've seen it a lot. Somebody beats you out and they come in at 640. Now, you speak to the mortgage professional and you could actually have them go to 645 and they qualify. The problem isn't in the qualification. The problem is mentally, they are uneasy to go to 645 for a home that they know is only worth 630. That's the problem. Until you close this deal by answering two important questions that your competition doesn't know. See, if it was one of your competitors, they go, well, let's keep looking for something else. But you're going to close more of the opportunities that you already have in your hands. This is an opportunity. You already have it. And not only do you have the opportunity in your hands that there's a customer you're talking to, they are found a home that they're ready to buy. So this is heartbreaking when you lose it. So here's what you do. Say, Mr. and Mrs. Customer, we got to answer two important questions. Question number one, how long is it going to take for this home that's worth 630 to reach 645? Well, I can show you that because I can access information that will give you the forecast for this zip code. And that is that if you wanted to, we could see in this zip code, the forecasted appreciation is 4.01% for the next year. Based upon that, I can tell you it will take 4.9 months for this home that's worth 630 to be worth 645. Let's call it 5 months. Now, if we set a closing date 30 or 60 days from now, that means it'll really only take you 3 or 4 months. That's nothing before you break even. So that's the first concern that I think we're over. What was important question number two? What does the future look like? Let's look 5 years down the road. Most people like to look like 5 years down the road. What does that look like for me? Okay. So 5 years down the road, let's take a look. We'll give you the forecasted appreciation for this zip code is supposed to be 4.28% per year average for the next 5 years. Now, what has it been for the last 63 years in this zip code? Very close, 4.51. So this tells us that 4.28 looks like we can gain some appreciation on a consistent basis. However, as smart as you guys are, as smart as I am, as smart as our customers might be, it's kind of hard in your head, if you think about it, to take 630,000 times 4.28% and compound that for 5 years, which is why we have to do it for them. Because when you do, you could see that the value of the home in just 5 years would be 783,000. You know, Albert Einstein said compound interest is the eighth wonder of the world, and he was right. Now, team, 783,000, we paid, or your customer paid 645. So 783 minus 645 gives you a profit in just 5 years, tax-free, of $138,000. Boom, mic drop. This is where you close the customer. Close more of the opportunities that are already in your hand instead of losing it to somebody else. And this is what it looks like. It shows you each year how you get there. And this shows you this is what your customer needs to have, and you will close more of those chances. Now, another one is somebody's thinking about renting. And the media right now, they're disgusting with all the stuff that they're putting on there. They're putting on so much stuff about where you should be renting instead of buying. They're saying, well, it's cheaper to rent. It's cheaper, right? Well, it's really not cheaper to rent in the long term. Maybe your monthly payment for a period of time, but they're not considering everything. So let's do this together, because I want to show you the right way to make the comparison of buying versus renting. Let's do this together. This is really an important one for you, because quite frankly, there's a lot of people making a life-changing mistake of renting instead of buying if they're qualified to buy. So here we go. Let's use a real example. $500,000 home, 10% down. So it's a 450 mortgage. And let's say it's a 30-year fixed rate. Let's call it 6.5% on the 30-year fixed rate, close to where rates are today. Okay. Now, if they were to rent, if they were to take a monthly payment, it's $4,200. If they were to rent, however, their monthly payment would be $553 a month cheaper. That's a lot cheaper. So people say, hey, maybe I should rent. It's so much cheaper, $553. The thing that they forget is that those rents on average go up by 5% a year, because the landlord knows that it is a pain in the ass for you to pick up and move. That's a hassle, but it's also expensive to pick up and move and go somewhere else. So they know they could ease it up a little bit, 5%. And by easing it up 5%, you'll live with it instead of spending all the money to move and all the hassle to move to another place that's also going to go up 5% a year. What are you going to do? Move every year? So this is where we're at. Now, how long are you going to be in the home? Well, I think I'm going to be there for 9 years. Okay. Now, here's where we help build trust, because here's a few things, Mr. and Mrs. Customer, I'd like to point out to you that are benefits of renting that most people won't say. Here's some other benefits of renting you didn't think about. Benefit number one, if you own, your real estate taxes could go up, and they probably will over time. So maybe on average 2% a year. So let's figure that in. Number two, how about repair costs? If you're renting, your landlord will pick up the repairs, but if you own, you got to figure you're going to be having some expenses for repairs. So let's figure that in. Number three, when it comes time to leave 9 years from now, if you're renting, you just say goodbye, thank you, it's been nice. But if you own, you're likely going to have to hire a real estate agent, hopefully me, and what we'll do is we'll put it on the market, but you have to pay a fee. So all those things should be thought about, because that's an advantage of renting over owning. So I'm going to factor all those in. Let me tell you, one of the major advantages of owning is that you get appreciation. And let me just show you in this zip code, for the last 63 years, it's been averaging 4.2% per year. But the forecast over the next 9 years is about 4.1% for the next 9 years. So let's factor all those things in, and here we go. Let's start off with the monthly payment. Now, I know it's $553 cheaper. Nobody's disputing that the rent is cheaper, but that's for the first year. See, let me show you a comparison for the 9 years you're going to be there. Here's year one, here's year two, year three, etc. The bar on the left, that's buying. The bar on the right, that's renting. And as you can see, this difference here, that's $553 more a month than it would be renting. But notice what happens in year two. The bars get closer. In year three, even closer. By year four, they're even. And then after that, renting's more expensive, except for one important thing that most people don't consider. And that is part of your mortgage payment, part of the $4,200 a month is principal. Okay, principal. You see, it starts off every month with $432 of that is your own money. Principal is not an expense. It's a forced savings account. It goes into the equity of your home. So it's just your money. It's kind of like if you had money in your left-hand pocket, you switch it to your right-hand pocket, you move the money, but it's still yours. So notice that every year that black bar gets even bigger and bigger and bigger. And notice that if you now consider that this is not an expense, it's your own money, by year two, you're actually even. By year three, it's more expensive to rent, than it is to own. By year 4, it's a lot more expensive, and so on. See this white line that divides, that shows you when you compare it to the principal. This is why we must show them step by step by step. Now, look, if you took all the money that you laid out on both, including the equity, you're still cheaper off by over $20,000. But now, let's take that equity bill, that $432 a month for the first year, because each month it goes up a little bit too. After 1 year, you built up $5,000. After 9 years, you built up $59,500. You see, when you first bought the home, it's a $500,000 home. You put $50,000 down, and your equity was $50,000. But now it's $50,000 plus the $59,000 you built up, because you only will owe $390,000 on the home. See, we have to show that to people. But there's other benefits. Hey, remember that appreciation? Remember Albert Einstein? Remember that 4.1% appreciation? Over 9 years, how much do you think that would be? Would it shock you that it's just 4.1%? That $500,000 home 9 years from now is $720,000 value. You would gain $220,000. Now you add that to the equity. You add that to the tax benefit that you get over renting. And now let's deduct the expense to sell the home, okay? Because we got to factor that in. And remember, we already factored in all the maintenance and repairs. We already factored that in the monthly payment. So we're taking all those negatives, and we factored the taxes going up every year. Over the 9 years, would it surprise you that you're better off buying this home compared to renting by an astounding, life-changing $285,000? Now, the longer you're in the home, the bigger the benefit. Now, if you're here for 7 years, 8 years, 6 years, 5, 4, whatever it is, you could see the benefit. Now, Mr. and Mrs. Klein, here's the thing. If you're only going to be in this home for a year, you should certainly be renting, because while it's great to buy, the cost of buying and the cost of selling would outweigh the benefit. But if you're here for 2 years or more, why are you not buying this home? Why would you throw away $19,000, $46,000, $76,000? Why? Or $285,000? Why would you throw that money away? Because it can change your life. Now, what we're trying to do is create wealth for our customer. Let me just give you some examples of net worth here. This is always a fun exercise. In the United States, all your assets minus all your liabilities, that's your net worth. What does the top 1% have? $11.6 million net worth. Big number. But notice how it drops to the top 2% to $2.7 million. Top 5%, $1.2 million. The top 10% in the United States have a net worth of $900,000. And to be in the top 50%, you need a net worth of $600,000. Now, here's the thing about buying a home. Do you know that on average, 2/3 of this money, on average, you know where it came from? Home equity. Yeah, it's very hard to get rich being a renter. And in fact, the net worth of a homeowner compared to a renter, this is not a typo, folks. It's 40 times a renter's net worth. This is what you have to stress with your clients if they want to rent, that not only is it smarter when you see, but they will cost themselves wealth if they continue to rent. Now, Diana Olick, as you know, on CNBC, she's like public enemy number one. She's been giving people bad advice forever. Let's just look back on the last 10 years and let's see what Diana Olick's been telling people, because you can go back and you can get the headlines. So back in 2015, in October 2015, so if you were looking at a $400,000 home and you listen to Diana Olick, what did she say? She said, don't buy it, because back in 2015, she said, we're in a bubble larger than we were in 2006. Don't buy the home. But prices went up 5%. So if you listened to her that year, you lost $20,000. The next year, does she say, I'm sorry? She says, no, she just says, hey, now we're in a new housing bubble, but prices go up again. Then the next year, what does she say? She said, homeownership does not build wealth. Oh, really? Who would believe that for the last 7 years that you did not build wealth in homeownership? And prices went up that year 6%. And then she says, it's better to rent than to buy in the housing market. Oh, really? Who for the last 6 years says, you know what? Thank God I've been renting. Thank goodness I've been throwing my money away on rent with no tax benefit, with making my landlord rich and paying off their mortgage, missing out on all the equity and watching prices go up. Thank God I listened to you, right? Well, prices went up another 5% that year. The next year, she said, the housing market's about to shift in a bad way, but it only went up another 4%. Then the next year, she said, next year is going to be hard on the housing market. It's only hard if you didn't buy, because prices went up 10%. The next year, she says, the housing boom, it's over. Really? Over right after she said that, prices went up 19%. And then the next year said the housing market is in increasingly big trouble, only to see it go up 6%. And since then, she said home prices may be turning lower, but we've seen it go up 6% in the last 14 months since then. So this is Diana Olick's world. This is the world of the media that doesn't care about telling the truth, that just cares about scaring you. So you would have lost out on $350,000. Make sure you show your clients this, okay? Now, where's the state of the housing market now? Is there another bubble? That's what your client wants to know. Remember that? Well, let's look at 2007 when there was a bubble. Inventory was 4 million units. Today, it's 1.3 million units. So almost 3 million fewer homes for sale. Our population has grown from 301 million then to 340 million now. So you got 39 million more people with 3 million fewer homes for sale. How are you going to have a bubble? And this is probably one of the most powerful ones. This is demographics. And I believe that demographics is destiny, folks. So here's the generations: boomers, Gen Xers, millennials, Gen Zers. These are the current ages that we are accepted ages that fall into the generation numbers. This is how many people in each of these generation groups. And this is their current home ownership rate. This was their home ownership rate when they were 30. And this is home ownership rate when they were 40. So we look at this and we say, what can we learn from this? Well, let's start with the millennials. So you can see there's a pretty big group of millennials, 73 million of them, and they range between ages 28 to 43. So let's just take not all 73 million. Let's just take a segment of these that have a median age of around age 30, which means their home ownership rate's 33%. So when we do, we could see that 45 million of them are in that pocket. Now, we know that these millennials, by the time they get to age 40 or 10 years from now, their home ownership rate's going to jump to 55%. So at 55%, that's a 22% increase on 45 million people. Well, that means there's 10 million more homeowners we're going to get. Now, what about the Gen Zers? You see, the Gen Zers, their median age is age 20, and their home ownership rate is 8%. But if they follow what the millennials did, 10 years from now, when they're 30, it's going to jump from 8 to 33%. That's a 25% jump. 25% home ownership on 69 million people. That's 17 million more homeowners. So if you add the 17 million to the 10 million, that's 27 million more homeowners. Yes, it's true. Some people might die off. Yes, it's true that many of these people will double up and buy as couples, but it still means that you need about 19 million net more homes. How many are we anticipated to build in the next 10 years? 13 million. So if you need 19 million and you build 13 million, you have a shortage. And what is that going to do to prices? Well, you know the rules of supply and demand. When demand exceeds supply, prices go up. So this is one of the best arguments you can give to your client who's hearing the bullshit in the media saying, oh, don't buy a home. It's going to be a crash. How are you going to have a crash if more people need homes than there's going to be homes available? Now, we anticipate nationwide appreciation over the next year to be around 5%. And by the way, if you want to follow me on Instagram, I have a lot of this stuff on Instagram. You could take it if you'd like and check it out if you'd like. It's I am Barry Habib. Just follow me there and you'll be able to grab all my stuff that's on there and all the videos. Now, if we have 5% appreciation, some people might say, well, maybe I shouldn't buy a home. Maybe I'll rent and put that money in the stock market because the stock market, boy, that's been flying. Maybe I can get 10% in the stock market. But they don't know how the math works. And let me explain this to you. Look, you create wealth through real estate. The reason why it's so much is because of something called leverage. Let me explain it to you. $500,000 purchase price. If you put 10% down, that's a $50,000 investment. If values go up 5%, it's 5% on $500,000, which is a $25,000 profit. 5% on $50,000, $25,000 profit. A $25,000 profit on your investment of $50,000 is a 50% rate of return, which is much greater than if you got 10% in the stock market. See that? I mean, team, this is what you have to be able to explain to your customers. Because now somebody might say, well, Barry, I got to make a mortgage payment on this. Yes, but you have to live someplace, don't you? See, either you're going to rent, and I explained to you just before why rents wind up very quickly becoming even more expensive. So there's going to be an expense to live somewhere. Unless you're going to live in a tent for free somewhere or always live with mom and dad, if you're going to live somewhere, there's an expense to live somewhere. And this is why leverage works. You see, you don't have to own a stock, but you have to live somewhere. That's why this is going to always beat the stock market. And I explained to you about the Josh Sitzer lawsuit. He started with the NAR. Okay. It's the same Josh Sitzer that created Landian. So, team, what I'm going to do is I'm going to show you a video. Get ready because it's probably going to piss you off. Okay. But if you go to their site on Landian.com, this is what's out there. This is pissing me off. It's probably going to piss you off. So here we go. You ready? Let's do it.
But what you don't realize is that you may be seconds away from a very costly mistake. Under new 2024 laws, sellers are no longer paying buyer's agent commissions like they used to. So that agent, you know, the one your friend introduced, he'll put you at a major disadvantage. Either he'll make you pay him a 3% commission out of pocket, or he'll put the whole deal at risk by asking the seller to pay him. Listen carefully, because there's two ways to avoid this disaster. One way is by calling the listing agent and telling them you're unrepresented. But since unrepresented buyers are typically harder to work with, just getting a listing agent to give you a tour or to read your offer can be really frustrating. The new smart way to buy is with a Landian low-cost buyer's agent. Just go to Landian.co, paste the listing link, and within seconds you've got a tour or an offer prep session scheduled. You'll save a lot with Landian by avoiding the 3% that other agents charge. With the flat fee at closing option, you'll save over $13,000 on a typical $500,000 home. And if you pay up front, you'll save even more.
Folks, how'd that make you feel? I mean, if you want to put it in the chat, I'd be very interested to hear your comments on how that makes you feel, right? I mean, that's not very flattering to you guys, okay? And it's annoying. Yes, I agree with you. It's BS. I agree with you. I agree with you. So this is why it's so important
what you don't
to get this message out. So one of the things that you should be doing is staying in touch with your customers and making sure you beat Landian to the punch. And repeat business is really critical, team. So you have to give your clients something of value. Fortunately, you can do this. It's completely free. Just have your mortgage professional include you in something called Home Report from MBS Highway. Home Report from MBS Highway. It's free for you. What they'll do is your customers get something co-branded with you, and it will tell them every month how much is your home worth and what is the forecasted appreciation in your market. Remember those numbers I gave you? You can have that for free. Here's your calculator for where you can save money, how you can pull equity, and then we'll show them properties on the market, which oftentimes people are curious to know what's on the market, and maybe they'll come back as a lead for you, okay? And I think that these are things that you definitely want to have at your fingertips. Look, it doesn't cost anything. Just tell whoever your mortgage professional is to co-brand you on Home Report from MBS Highway, and they will do it. And the nice thing about it is everybody wants to get this, so you'll build your database for free as well, because as they tell their friends and the family to get this. So folks, we're kind of coming right up on time, but I want to leave you with an important message, is that your best opportunities lie ahead. They're in front of us, regardless of the market conditions. If you just close more of the opportunities you're given, if you just put yourself on the top of the food chain, use the right tools, use vulnerability to gain trust, use your knowledge and gain knowledge to build trust, then your best opportunities are ahead of you. Here's a great example. Let's go all the way back over 100 years, right, to 1899. This guy, Charles Duell, he was the head of the US Patent Office. And he said, we should close the patent office and save money. And they said, why would you want to close the patent office, Mr. Duell? Why do you think we'll save money? He said, because everything that can be invented has already been invented. So this is just the type of thinking that doesn't allow us to always remember that our best opportunities are ahead of us. And Leo, I think we're kind of right on time here. So I wanted to make sure we did that for you guys. I hope that you guys enjoyed our time together today.
Oh, that was so good, man. And I just dropped your Instagram here on the chat. I took pages of notes again, and I had taken pages of notes when I heard you previously. I'm going to watch this on replay, brother. Thank you so much, man. And everybody go ahead and give Barry a follow on social media. Give him a huge shout out. Thank you so much, brother. God bless you, man. Thank you so much for what you do. You're a blessing.
God
Thank you.
bless you guys, and thank you so much, everyone. What a beautiful group, and your comments are extraordinarily meaningful to me. So God bless you, and thank you, thank you, thank you. All right, everyone, you be well. Thanks,
All
folks.
righty. All
Bye.
righty, guys. Have a beautiful day.
You
Let's grow.
too.
All righty. If you guys registered for this webinar, you guys will get the replay. And I encourage each and every single one of you, watch that on replay. Like, seriously, you guys need to memorize that stuff. So thank you guys so much for being here. Once again, I hope you guys got as much value as I did. And make sure you don't miss these trainings because we got some more fire coming up. Let's get it. See you guys later.